Welcome. I'm Ira Epstein of Linn Associates with your financial market wrap-up for this Tuesday, September 21st, 2021, 6:10 p.m. Central Time. Before we go anywhere, do you see up here this icon? There's an icon there. Click on it if you want to get into the live webinar I'm going to hold on Wednesday, September 22nd. That's tomorrow at Chicago time. That's 12:30 p.m. Central Time, but I open at 12:15. You need to fill out the form. You'll be sent an email with your passcode, how you get in. And most important there, you can ask me the questions early. You'll see my email address in it. Just click it. A form fills out. Tell me what you want me to cover, and I'll do it. Now let's talk about tomorrow. What's the elephant in the room tomorrow? Forget all the other reports. It's going to be the FOMC meeting that ends at 1 o'clock. We get the statement that ends probably at 12:30, but they'll come out with their statement. Everybody will read it. You'll get the first reaction. Then the question and answer period of Fed Chair Powell begins. So what are we looking for? Well, obviously, the first thing is the tapering. Is tapering going to happen? Is it November, December? That's what the market thinks. The market's betting heavy that it's November. The second thing, how much tapering? Is it going to take a year? Is it going to take 8 months? How much each month? What are they tapering? Tapering, remember, still means they're buying treasuries, just not as much. So it's not as though, interest rates changed. The third thing, the dot plot. What do the members think? What are they looking for when interest rates might actually begin to move higher by moves by the Fed? The fourth thing, is the inflation we're seeing transitory or not? Now, in between that all, you're going to see what the Fed likes, doesn't like, how it's looking at COVID, how it's looking at they'll probably get asked questions on the debt. U.S. debt, we're running out of money on the budget. Congress is, again, dysfunctional. If they honestly think the Democrats, they're going to be able to get the Republicans to agree to an open check for a year while they don't have a debt ceiling, that isn't going to happen. So I hear crazy things all the time, but, there's nothing wrong with floating them out there to see what you get so you know what you end up with, right? Nothing wrong. If you negotiate, that's what you do. In the meantime, metal's a bit lower. The dollar was down a fraction today, but tonight foreign currencies fairly stable. Why would they do anything in front of all this? And looking at the pound, remember, Thursday's the Bank of England meeting. I think it's Thursday. We get the Bank of Japan also coming out, and then we have like a series of small central banks coming. U.S. notes and bonds, fairly stable, not moving. Energy prices, still good. Already the OPEC ministers are talking about what do they do in October. That's only 10 days away. At the next OPEC meeting or so, will they go with the other 400,000 barrels? My guess is they do. The market can support it. Prices are staying strong. So when we look at the S&P on a weekly basis, you finally made it back to the 18-week average of closes. Not the first time we've done it, but all important. Here's the other thing. For 2 decades, September has been notoriously bad for the stock market. This is no exception. Let's get through it so we can get to some trading that makes more sense. This is your washout phase. How deep it goes, nobody knows. Is it a 5% correction, a 10%, a 20%? Nobody knows. We'll see as it ends. But what you do know is markets often go to the 18-day average, in this case the 18 weeks since it's a weekly chart, to figure out what to do next, and it's exactly what this market has done. Now when we come to the daily bar chart, you're not getting much of a bounce. The market's still in a problematic stage. You've got the pattern of still lower highs, lower lows. The low today, intraday, was 43.29 and a quarter. You gave up by the end of the day and closed lower. Now, if you go in and you look at a tick chart, a 15-minute chart, you'll see the market spent 2/3 of the day higher. And that's what I expected after that break, a Tuesday reversal, but you didn't close strong. So this market has still got a problem. It is not out of the woods in any manner whatsoever. The support zone is the 100-day average. The resistance is the 18-day average of closes. The Bollinger Band, all you're trying to do is move to the right-hand side of it. You've got 2 days under it. You can go up to 5, but it's rare that you do that. What you don't want to see, that would be very, very bearish, is for the market to latch onto that and just keep following it to lower and lower levels. That would cause the market to develop an embedded reading in the momentum. It's not there. It hasn't even begun. So what we have is an oversold market, I think, trying to give us a bottom of sorts between the 100-day average and the lower Bollinger Band. It is oversold as can be, and the pros used the rally today to again sell into the market. The Nasdaq, same thing. The market was unable to get back over the Bollinger Band. It's fighting at it. You only stay out of it 5% of the time. My rule of thumb, let's go through that one more time. Each consecutive close under the band takes away each one of those 5 percentage points. If you go back and you do counts, as I call them, times that it was over and under it, you'll come up and you'll see for yourself if that has any merit to it. That is not a turning point. When a market latches on, it's often a sign of strength, and then you're looking to see how's the market doing. Did it keep the pattern of higher lows, higher highs? If you start losing that, it's the first kink in the armor, and then if it lets go of the slow stochastic, you go back to that number. So we'll see what happens. The Dow, same thing, fighting at the lower Bollinger Band to get back in, but oversold as can be. And the Russell stayed to the right-hand side, as you can see on it. I'll come back to the market from yesterday. Rallies would be, I think, a lot of resistance here. Instead, what it did, it's trying to use that 200-day average, this gray line right through here, as a number. What's the common theme, though? They're all oversold. They're not embedded. So it's a correction. A nasty correction, one to be expected, and at the end of the day, probably healthy for the market. In the VIX tried to pull back within the Bollinger Bands. It peaked yesterday. We'll see what it does tomorrow. It's overbought. I still contend it's going to try to get back down there when the stock indices make their low. In the 30-year bond, why would anybody be involved in this until we see the Fed, what they're going to do? You're getting a lot of sideways action through here and no trend, higher high, lower and low. In the notes, at least you have lower highs, lower lows, bearish, momentum flat, but I doubt you're going to get a lot of money taking a position until they see the Fed statement. In the meantime, the resistance is 133.09. Any move over 133.11.5 negates the downtrend, could put the market into an uptrend, and if the market gets disappointed by the Fed, then I'd look for 133.22. Let's assume whatever the Fed does, they come out and they tell the market, oh, there's going to be a December tapering or all. I still don't think you go into a major bear market. I haven't bought into that agreement yet. The market seems to be happy in the 130 range in the 10-year yield. In the dollar index, you got up to the upper Bollinger Band 3 days in a row, are having the trouble right where I teach. That's where it should be. 95% of the time, the market will fight at that band. It's difficult to stay outside of it. In the eurocurrency, yesterday, you got down to the lower band. That's where I think the pros covered, and you can see they don't look bad. There's no reason to be a buyer here yet, but there's reasons not to be short. There's a very big difference in that thinking. In the British pound, like the dollar, why would you want to sit there and play a game with this in front of their bank meeting as well? I don't think you want to do that. Bitcoin, you do realize Bitcoin has taken a beating here. It's back down to the $40,000 range. The market is broken out to the downside. If we take a look, you were at the bottom quadrant under the Bollinger Band, but not today the bottom quadrant, but pretty far down. Will we find the battleground, this 100-day average? I think so. I think the market will try to make it slow in between the Bollinger Band and that, and I know it's oversold, but that's what I'm expecting. In the Brent WTI, you can see the differential coming in rather sharply. So Brent is losing to WTI oil here, and you can see how it slipped down. It lost its embedded reading. Now, this is how the market looked on Friday. You lost the reading yesterday. That's Monday. Today, Tuesday, you didn't get it back. I'm going to look for prices at the 18-day average of closes. I think that's where it's going to end up going and neutralize just the way that the WTI did. You lost it. My rule is you normally go back to that 18-day average and you try to fight there. Heating oil, lost the embedded reading, did it the same way. If we had a classroom, I'd give you A's if you can call that, because it's not that difficult. But if you say, no, it's just not going to do it, you're going to lose more times than not. You'll get an F from me and you got to take the course again. Natural gas. You lose the embedded reading. What are you supposed to do? The odds favor you're going back to the 18-day average unless you get it back the very next day. You didn't. The pros are selling this market short. And bingo. They're out. You heard me, out. That's all it was worth. That was the money play, as I like to call it. So remember to click this icon for the webinar. Do it now. And if you want to see our new trading kit, this is the way to do it. Our trading kit covers everything you need to get yourself going. You're going to have chapters galore on how you start trading. But more than that, you're going to get charting. It's included in it. You're going to get the tools for beginners. You're going to get my different courses that are free courses that I put out, not my paid for courses, my enhanced Bollinger Band and the others I'm creating. You're going to learn chart patterns, very important. Pivot point, the Arun indicator, how to work with that. All these video courses are included. Cause and effect is something you have to pay attention to. As the Fed starts the tapering, we'll start looking again at words you're not used to. M1, M2, and M3, velocity of money moving through the economy. Traders will focus on it. I created a simple sheet. You learn it in all of 30 seconds, the concept behind it. How do you get it? Just go to the website on the bottom right. Just click on free offers. Everything you need is there. I'm Ira Epstein. You have a good day. I'll see you tomorrow, I hope, in the chat room, I guess. Take care.